Good evening, everyone. Time for another silver update. This is the US dollar versus the Chinese yuan, and I've been pointing out that I was expecting a drop below this support line. We now have it confirmed that the dollar is now doing another down leg against the Chinese currency. It was actually fairly well predicted by this trend line that we have here, because you can see that as soon as we got right to where that trend line was, we turned and went down. So that's the trend. The trend is, I said for the longest time, that the dollar is going 1-to-1 with the Chinese currency and beyond, and there's no indication that this trend is slowing at all. You can see that it's a long trend. We've come all the way from 8.3 and we're now approaching 6. So the dollar is becoming worth less and less. Now, a lot of people argue that it's good to have a weaker currency. Traditionally, that's never been the case. Only modern economists argue such a thing. As the Chinese currency strengthens against the dollar and against other currencies, that means that imports into China are cheaper, especially oil. So their energy inputs are going down. They're still the chief manufacturing nation. That means that they import the raw materials and then they manufacture them and sell them. Now, the prices on the exported goods go up because of the currency, but that's offset by the price of the raw materials. So, traditionally, it's always been a good thing to have a strong currency, and the Chinese currency is getting stronger and stronger. The American dollar is getting weaker and weaker. Now, this debt ceiling debate is dragging on, and they're starting to pull out some of the big guns. We talked about how the food stamp glitch, as they termed it, I thought that that was kind of a test run. We now have the news out today. This letter from the USDA going out to the states. This was posted on Zero Hedge, and this letter is telling us that they will not be paying the SNAP payments for the month of November if this debt ceiling issue is not resolved. So that's a pretty scary thing. It's stamped October 11th. It looks legit, and it's being reported from other sources. So it looks like they're starting to crack down on entitlements, and that's to be expected, because when the government wants to go deeper into debt, they will threaten the things that have the most political impact. Now, we also have a potential shutdown of Section 8, and that also is going to happen November 1st. So if they don't get this resolved. Now, Section 8, this is about Massachusetts. A top Massachusetts housing official warned the state will no longer be able to pay landlords rental assistance for low-income tenants if the government shutdown continues through the end of the month. Aaron Gornstein, Massachusetts Undersecretary for Housing and Community Development, said the state is operating on its Section 8 rental assistance money off money that it received before the federal government shut down on October 1st. However, if Congress does not reopen the government, that money will run out. Gornstein's comments come as social service providers and government officials have been trying to warn the public about the long-term impacts of a shutdown, even as many of those impacts are not yet apparent. Even with Section 8 rental assistance program, it's hard to determine the exact impact of the shutdown. Around 20,000 Massachusetts residents get Section 8 vouchers administered by the Massachusetts Department of Housing and Community Development, but around 55,000 Massachusetts residents receive housing vouchers from local housing authorities. So you're going to be looking at a number, say 30 to 50 times that for the whole of the U.S. So we're going to be talking 1 to 2 million that are receiving these housing vouchers. So we add that together with the SNAP and Jack Lew mentioning Social Security, and it looks like they're setting up for an economic catastrophe if the SNAP payments, the Section 8 payments, and Social Security payments are cut off. I can't imagine how fast things would unwind if that happened. So there's a great game of political theater going on right now between the president and the Congress over this debt ceiling debate, and it's really starting to heat up now. Now, Fitch has just warned that the U.S. credit rating is at risk. Fitch Ratings put America AAA credit rating on watch negative for potential downgrade Tuesday, saying the political brinksmanship and reduced financial flexibility could increase the risk of a U.S. default. It raised concerns that the U.S. may be forced to incur widespread delays of payments to suppliers and employees, as well as Social Security payments to citizens, all of which would damage the perception of U.S. sovereign creditworthiness and the economy. Now, I don't really understand that. You would think that if the United States government decided to not pay their Social Security payments so they could pay their debt payments, their credit, that would actually be an indication, a positive indication for their debt rating. But these credit rating agencies have always come on the side that the U.S. needs to go deeper in debt. So I'm not really sure what type of quality of advice that is, to advise continually to go deeper in debt. Otherwise, you're going to lose your credit rating. At some point, you would think that the credit rating agencies would begin to downgrade the debt just based on the size of the debt, and that ultimately causing some type of risk of default. But probably the case is that these rating agencies really don't care about whether there's any type of inflation or not. They really only care about outright default. But of course, inflation is just as damaging to investors as default ultimately in the long run, because a hyperinflation means that the the creditors are going to be paid back in worthless currency. So that is a risk, but I don't believe that's a risk that Fitch warns about. So we know that we have a artificially low pegged interest rate right now. Now there is some type of action going on in the 1 and 3 month T-bills, and that's covered on Zero Hedge, so they're jumping up a little bit, but still those rates are pegged so low that they're nothing like market rates. And of course, that's the problem. There really isn't a need for these rating agencies. After all, the whole purpose of having a free market in debt instruments is to buy and sell them and establish their price, and based on their price as a discount or a premium, that's how an interest rate is established. So it's the free market that determines the risk of a debt obligation, and that is the interest rate on that debt obligation. What happens when you have the rating agencies such as Fitch, Moody's, S&P come out and give these AAA ratings? That short circuits the market mechanism to establish the risk. Traditionally, the higher the interest rate, the higher the risk. The lower the interest rate, the lower the risk. So I don't see these rating agencies as a good thing. I see them as a way of short-circuiting the market mechanism of determining risk. But of course, we have to have them because certain pensions and other things by law are required to invest in certain things based on their rating. So we've gotten into a situation we can't get out of, and of course that politicizes the rating agencies. I've mentioned before the fact that the Attorney General went after one of the rating agencies when they issued the last downgrade against U.S. sovereign debt. So it's all politics, it's all a big game, and they're playing a lot of brinksmanship. Now, what does that mean for the silver price? Well, we had a bounce in the silver price today. It looked like when the debt ceiling debate was coming towards some sort of resolution, we actually got a sell-off. Now we have this dramatic spike down and spike back up. Of course, that's patently absurd. You can see here's a dollar move from 2050 to 2150 there, a full dollar move. That's going to be a nearly 5% move in the price of silver. What does the price of silver have to do with debt ceiling debates? Not really much of anything. So we know that it's a manipulated market. We know that they use opportune times to sell off or to buy. You can see here on the volume, we've got a gigantic 50,000 spike here, and that's coming in the after hours, so that's very unusual. So we've got very strange things going on in the silver and gold market in relation to this debt ceiling debate, but ultimately they're going to find their own value based on the fundamentals, not on some type of political machinations. So this downtrend is still established. There's a couple of them. That's the major downtrend, and the next one is this downtrend, and that brings us down to the $22 price. We really only need to get a break above $22 or so in the future to establish an uptrend against this line, and we're still looking at about $25 for a reversal or a resumption of the bull market to break this trend line and to go back and challenge the old highs. And we'll talk to you next time.